In my opinion, the sharp flow is the flow that cannot be monetized by the financial institution effectively with the appropriate level of risk taken.
Risk reward. Yeah, I mean, that's very true, and I completely agree with you. So it's more about the risk appetite of the broker and whatever you're not willing to take on because of your risk reward factors. So it's something that you maybe financially can't clear because you don't have enough capital, or it just doesn't make any sense if you're plotting it through different tools that we can use and we will talk about.
Yeah.
But one thing that we often talk about again is that what's sharp for me may not necessarily be sharp for you, right?
Absolutely, absolutely. Here I would say that, yeah, like everything is kind of relative. So it significantly depends on the expertise and of the team, of the risk management team, because you know, like there are different kinds of flow that cannot be monetized by the retail brokerage with the average infrastructure. Meanwhile, the bigger entities like liquidity providers are managing to create the setups where even the sharp flow is monetized, and basically they manage to get some margins and they take a big piece of the market at the same time. So basically this is a big stuff.
Predominantly because they see more flow, or is it more because they have different tools to monetize it? What's your opinion on that?
I would say that they are just a bit more adaptive.
Sophisticated?
Just adaptive, I would say. So like they find different ways of offsetting the flow, let's say, or just taking it like from your book. Especially speaking about this gold flow that is wandering around, and a lot of companies are still struggling, and many of those are still not even recognizing that these specific traders are doing. So yeah, the cornerstone here is that the flow that is sharp for the retail may not be sharp for the institutional. And yeah.
And also, as you said, the knowledge of the broker plays a massive role here, because sometimes what Roman would see as a healthy flow, a broker might be wanting to offset, and the easiest thing to do is just send it to the liquidity provider, right? But very often you can still monetize it. But there is still some type of flow that you can't monetize.
Yeah.
So should we highlight what we think what kind of flow it is? Okay, go for it.
All right. So I would say that in general, we could break the sharp flow into several different categories. The most obvious and the one that is very hard to monetize is effectively the so-called HFT trading through the different means. Either it's a latency arbitrage, either it's whatever news, faster news feed, or whatever is there, but just creating a positive or creating, we can say, the market impact within the short period of time.
So latency arbitrage, swap arbitrage.
Swap is a bit different.
Dividends.
Yeah, so basically the one that is the most, the hardest to monetize is the latency arbitrage.
But
right?
you should be protected from it by your technology provider, right? So by default, if your technology provider knows what they're doing,
ideally
you won't be opt.
Ideally, but a lot of brokers they still keep running the lowest cost,
auto execution,
the low cost configurations, and they actually underestimate the impact of those stuff, and like they would not pay for the liquidity breach, like let's say 5K per month. Instead of that, they will be executing everything internally on the MetaTrader side, which is like like executing trades with closed eyes.
Another thing that happens, if you're not familiar with it, is that MetaTrader would execute everything. Well, first it's auto confirmation, right? But the other bit of it is that it always executes on the top of the book level. So it doesn't matter how much I want to trade.
Absolutely.
I will not be swept through the book. I will just be executed on the price that I see at the top layer. And since your P&L is ultimately a function of your spread, it negatively affects the bottom line.
Absolutely. But this is one kind of, let's say, arbitrage, right? Or whatever, sharp flow, hardly monetized flow. I would continue the list. So, right, we have latency arbitrage, which is the most obvious, as we said. We have swap arbitrage, again, quite clear and obvious how to identify it. Then we have the corporate action stuff, which is basically, this includes earning releases on the X date, the the positions.
So the broker is not adjusting it?
Yeah,
is that what you're trying to say?
Absolutely. There's still a lot of brokers that are not adjusting the dividends basically on the earning release on the X date. And there is another one which is basically very similar to that, is on the it's basically dividends, whatever, corporate actions, right? So this is one of the, these are one of the, I would say, the most popular group. What did I have here?
I think you're good.
There is a second group which is less obvious.
Market manipulation.
Kind of, yes. All the manipulations across the market, right?
I can finish your sentences.
Please. No.
Okay, what kind of market manipulation are you familiar with?
Look, around 10 years ago, I first encountered the traders from China that have been trading gold. They've been depositing like 50K per account, and they've been depositing like 5 a.m. in the morning, opening the trade right away. You are sitting at the desk already dreaming about going to bed. And these guys, they start trading like 50 lots each account, and like within a couple of hours, they are tripling their accounts and going out without you realizing it. So basically, these guys, they are still there on the market, and they are, I'm pretty sure you guys, majority of you have encountered that. The nature of that, to be honest, we can just be speculating here.
Well, I think we know of a few ways what they're doing, but go ahead, speculate, entertain me.
That's what we do here in the industry. So initially, as I know, they've been buying a lot of, let's say, opening a lot of positions on the CFD brokerage and basically going on the underlying futures market and just moving it on the very low liquidity sessions, like Asian session. That's why they've been coming nighttime. Now I believe they create the market impact just by sending this flow, and the liquidity, the brokers are further booking this flow and sending it to the LPs, and the LPs are sending it further as well. And eventually these guys, they are like just the biggest market makers in the world, just being the clients of the retail brokerages. This is one of the guys, and what I believe is that the flow is very hard, but we see the LPs that are actually manage to monetize this stuff.
Yeah. There are a couple of LPs, and usually you will end up with someone, I mean, we can give some names, but someone like Citadel, for example, they say they can manage that flow because of the amount of flow that they have. And of course, some other institutional LPs that I know of in London, they would say they offset part of it during the gold fixes in London. I don't know if you heard of that product, but ultimately, there is a price for gold that is fixed twice a day, and was it 5 or 7 banks? Five major banks participate in it, and they kind of auction it. So they say this is the price based on my exposure, and other banks say, oh, this is the price based on my exposure, and then they fix the price and offset the exposure between each other. So as long as the liquidity provider has access to this gold fixing, I mean, it happens twice a day, so it really depends on how you're going to calculate your capital adequacy and what you're going to do with it. But it's one of the ways. And I mean, another one is our well-known shit sandwich, ultimately, when just they cover it up and then send it to the banks, or ECNs or whatnot, or market make on it even. But that can easily be seen through spread decay if they're trying to market make on it.
Yeah, absolutely. Spread decay stuff is a killing. So one more thing basically is trading around the rollover time for the crosses. I've seen these guys, and like this is one of the most interesting lately. So you can see the trades between 12 a.m. and a.m. right night, 12 a.m. and 1 p.m. 1 a.m. again. Sorry, whatever. We are speaking nighttime now.
Midnight to 1 o'clock at night.
Midnight and 1 hour after the midnight Cyprus time. So
Cyprus.
Just to clarify. So basically, those guys, they are trading the crosses mostly, and they have the deals like for 30, 40, even sometimes more than 1 hour. And it's always profitable. I don't know, again, just for the sake of speculation, is like I've heard that this kind of group of interbank dealers that are trying to, they have basically the inside information how they will, let's say, do the reconciliations, and they open the positions, so basically they distribute it further and further up. Yeah,
well, you do from time to time come across trading like that, and to be honest, back in the day, when I managed an FCA regulated broker, we had someone moving the market in Canadian dollar, and it was definitely insider deal. Like it could have not been anything else. Like, because we went checking the obvious things that could cause those issues. So we went through our trading conditions, we went through our setup, we went through our liquidity, we went through everything. But it was insider dealing for sure, and we just reported the traders, of course. But
that's interesting. Actually, you just reminded me about the only one case of insider trading that is the most mysterious for me still till these days. We had a client that used to trade only British pound in anticipation of some very important pound news like GDP, maybe a couple of others like CPI and some two more. Like he was entering 3 times a month, like 30 minutes before the news, towards the direction of the macroeconomic release, and closing it like within 10-15 minutes after. Like every
You should have copied him.
GBP. I tried. I tried. But eventually, I don't know, I was not that lucky, and he started losing. That's basically
the story about like
that's my karma. I don't know, whatever. Just should not be copying the client.
But going back to those kind of abusive behaviors, and when you find them, the obvious thing to check, and I think that's what you do usually with your audits, the obvious thing to check is your trading conditions. So the first place you go searching when you find that someone is outside of your deviation, of whatever your expected revenue is, but we will cover that in a second. You start checking your trade conditions, right?
I would say that this is the third.
Yes, so we're slowly moving there. Yeah,
under our classification, Dealers Connect classification, whatever. So this is basically the abuse that comes by exploiting your maths or trading conditions or promotions or whatever you have. But in general, we call it maths.
So they're not trading the market; they're trading you. They're trading your setup.
Yeah. And especially like, okay, we got latency abusers that are trading your infrastructure, but here they are trading your mathematics. So
we've not charging swaps.
Yeah, like we've got some cases with a positive swap both sides and stuff. But okay, this is a human factor error. What to do? But in general, yeah, we've got a lot like promotion issues, different. By the way, it's interesting case again about the very high leverage, like over leveraging some of your trading products. I see, right?
Yeah,
this is interesting subject. I've seen a lot of companies that actually giving like easily 1,000, the leverage of 1,000 for gold, let's say. But if you want to be a bit more, a bit more predictable or like fair.
Defensive? Can you call it?
Defensive, yeah, exactly. Thank you. You've been finishing my words.
Yeah, I know.
The sentences. So the point here is that, and I think on the very first Dealers Connect, we had one speaker that was covering this subject, and it's called asymmetric leverage effect. So let's say we have a gold leverage of 1 to 1,000. then broker is giving the leverage of, the gold trading range is 1% per day, let's say. And then we have broker that is given 1 to 1,000 leverage. So it means that if I open every day, let's say, and every day the trade on the full leverage, I can get times 10, let's say, my account, just because 1,000 leverage times 1% will give me 10,000%, which is basically 10 times. Am I correct at all?
I wasn't following.
Anyway, okay. It gives me. It
Let me get the calculator.
Basically, it gives me a reward of 10x. So me as a client, I can lose $1,000, let's say, but I can make $10,000.
It's about risk reward.
It's
again,
about
how much
risk
you're
reward for the brokerage.
How much you're risking, and how much what's your potential upside, and what's your potential loss.
Exactly.
It's
so,
a
and ideally, leverage should be based on the volatility of the symbol and stuff. And I believe that this is a basic stuff. I'm sure a lot of you know about that, but
if you'd like to get a formula, let us know. We'll send it in Dealers Connect.
Yeah, still, if you want to do how to multiply and divide, we can help you with that. In general, yeah, we still see a lot of brokerages that are doing that. This will be recorded, so hopefully it will be used, maybe useful not for you, but for someone else.
Volatility arbitrage.
Volatility arbitrage, this is what we have covered now. Just because you are not following, you missed it. But
no, I'm saying it's called volatility arbitrage.
Ah, all right. So I was not following.
All right, fair enough.
We call it internally, we call it volatility arbitrage. I'm not sure if, guys, this brings you a bell or whatever, but in general, it's the same stuff as the news trading, right? You open buy, you open sell just before the news. It's the same stuff, but just sometimes you don't need the news release for that. Sometimes you don't need the weekend and the weekend gap for that.
Sometimes you just need Trump to tweet.
Trump to tweet, or some not very detailed, let's say, dealer to put the leverage for the instrument that is not supposed to be there. So this is another story that I would like to cover. But you have anything else from your side?
Well, I mean, I don't know how relevant that is, but a very amazing marketing campaigns that marketing sometimes comes up with. Like, I don't know, tradable bonus, one of my favorites, of course.
Without any lots to be traded.
Yeah. Without requirements to have any.
That's basically, to be honest, I thought that nowadays we don't have any brokers left that are still doing that. But okay, we are doing some audits and stuff. And we've seen those. Sometimes I just don't believe my eyes when I see that. But this is the most
I sometimes want to open an account. But unfortunately, I'm not in that line of business. Fraud is not what we do. So trading conditions like that, not just necessarily the leverage, but it can be something very basic, something that marketing didn't think of.
Yeah, absolutely. Like promotions and stuff. This should be like well thought. It should be. By the way, also like I've encountered many companies where marketing and dealing, they never cross the lines, let's say. They never speak, or sales. So the sales manager is given the deals for the IB. The IB is already happy because he brought a lot of toxic flow. The sales manager is taking his commission. Dealers is sitting there until they were asked.
Multi-level IB commissions where you end up paying more than you're making, for example.
Yeah,
that's another good one, right?
Absolutely. Yeah. Absolutely.
So I think we've covered, like from the top of my head and from my notes, I think we've covered most of the cases that we can have. So one would be technological arbitrage, so to say. The second would be market abuse. And the third would be arbing the broker, ultimately. Arbing the trade conditions of the broker.
Broker's ignorance, unawareness, whatever, yeah.
Yep. So how do we identify those? Without just eyeballing, but you can eyeball as well.
Eyeballing is the old school approach. I believe a lot of companies are using it. Look, we have one method for identifying, I would say, like 70% of abusive and non-retail flow. By the way, I will just comment on that. Like in my opinion, the brokerage company is there to service retail clients. Whoever are non-retail, they could be either abusers, either professionals. So you as a broker are not willing to hold non-retail client on your book. So basically, regardless of if he's abuser or he is a professional trader, he is not your client, at least not on your book. So yeah, and now how to identify. The biggest basically share of those abusers is about the latency arbitrage and those guys who find the breach in your infrastructure. So how do we define the latency abuser? Maybe someone can share the experience. Victor, I'm sure you know.
I'm looking at like half the audience here knows. Yes.
Yes, please.
That's a good one, by the way.
I think previously it was a case of the eyeballing, but now a lot of the technology providers are providing TraderK the reports for us. And that's where I think I've even spoken to you a couple of years ago, banging on about how we can get our hands on that. Because when we were sending stuff through to bigger LPs, they would always throw back a TraderK report to us and say, these guys are arbing, these guys are latency arbors, get them off their book. So, but now that's accessible to us on the kind of broker level. It's been fantastic.
Precisely, and I think, thank you very much. I think that's like the most important tool, and it's quite amusing that I will go and I will roll as I do. It's amusing that some brokers are still not using it, and because because it is something that, for example, in our system, we've just released it for all clients. I don't know how this works. Okay, maybe I need to. No, Roman, it doesn't work. I'm sorry for that. Hopefully, I'm not gonna. Okay, yeah. So we just recently, and we're still rolling it out to all the clients as a part of the system. Just recently added for clients because there is no way. Okay, there are a lot of tools you can use, such as, for example, I don't know, last look or whatever in the system. But without looking at the decay report, you don't really know who to last look, and you don't really know who to set up in which way. Bran, could you please try to move it?
And could you stay with us, please, because we will have a couple of other slides.
Yeah, so, just the first, go somehow, I don't know. Okay. Yeah, just go first, and then we can go second, and then we can third. In fact, if you really want to, we can go third straight away. Like, we can go in the graph straight away. So this is just like where you see your accounts. You could see whatever, like, does it require a review or not? Could you please go to the next one? And ultimately, in the next one, you would see that then you mark it out based on T minus and then T plus. So if you go to the next screenshot, please. Yeah, so one of the most important things, if you're not using a spread decay, is that you need to look at T minus and T plus, because you want to know what is happening in the market before the trade happens. So 0 seconds, that's when the trade happens, right? And then you can see how quickly the client goes through your spread, because again, it's a mean spread function. Your profitability is your spread function. How much spread are you capturing? So this is how you ultimately ensure that you capture your spread.
And tell us why is important to monitor back.
Because you need to know your liquidity, right? So you plot it against the liquidity. So if you see that something is happening with the liquidity there, potentially, what is that arbitrage called? When you place several trades from several accounts,
Latency, no?
Oh, probably
say.
latency. But you had another idea of how you use it,
Yeah,
right?
it's because actually sometimes we discussed it with Elina before, and it's good that they have it here. Actually, sometimes when you are a big broker, you may find the cases when client is not opening the trade when the market is moving, right? But he's closing the hedged positions and he's closing the opposite position. So the position could be there like for 1 day, 2 days, or so on. But he will get his.
So he's offloading. So he's been loading before, and he starts to offload, right?
Instead of loading, he's offloading the opposite direction. So yeah, it's kind of important stuff, and I'm surprised, guys, you have it here. Really surprised.
Yeah, thank you. Yeah, you can also do delayed hedging.
I didn't touch this.
You can also do delayed hedging. So if you see if the account is marked and you know, okay, so the spread decay is, I don't know, 50 milliseconds, what you can do, you can internalize the trade for 50 milliseconds and then send it to the liquidity provider.
This is what I was waiting for, actually.
Well, you're good to set it up now.
Cool.
Right, and you want to show us, the next one is just showing like there is some abnormality there. So this is what you were, Roman, describing in a way. So there is offloading. Can we see this next screen? That's, Roman, your little secret tool, isn't it?
It's not like secret tool, but it's kind of my approach. You know, like last couple of years, I've been seeing dozens of brokerage companies, and I actually, Brenda, is there a way just to lift it a little bit up? Huh?
5 euros. That's
okay.
cheap. That's cheap, Brenda.
I'll put on demo account.
I think I can just pull it down.
It's okay. Just bring it back. It's okay. So basically, guys, what I realized is like continuing my idea from before is like retail broker is there to serve retail clients, not the professional clients. And if we have, and actually, like, what are the common characteristics, or what basically differs retail client from non-retail client? If anyone would like to give their opinions, please feel free. It's very interesting for me. Performance is clear, but there is a bit more.
Thank you, Roman. So, I mean, profitability, size of the account, basically how sophisticated a player they might be. And in my opinion, the only reason that these kind of traders would come to an FX-CFD broker and not go straight to COMEX or CME is because it's not possible to do it there. So things like hedging, the leverage.
Because they're protected.
Because it's not allowed. It's against the rules.
Yeah. Thanks a lot. This is like, it makes absolute sense. It's just, you know, like for me, I have to find dangerous clients from the millions of trades, let's say. And if I'm there like to go, what we are doing, like audit, within last 3 years, we check like the health, let's say, of the brokerage, right? And what did I find out is you have to remember that the P&L of the brokerage is always constructed from the commissions, spreads, swaps, and all the costs, let's say, trading costs of the retail clients. So on the long run, though, we're not speaking about 1 month. We're speaking about the, let's say, yearly term. So I realized many times, like I've been checking one and after another, and let's say if a broker made 10 million per year as the revenue, he will have like 7 million paid with the spreads, another 2 million, let's say, paid with the swaps, and another 10% are just market factor, randomized market factor.
That's probably he took a lot of risk on as well, when a risk-reward ratio would be...
Yeah, absolutely. So the point here is that the retail behavior is basically is to play the game and to pay for the game eventually. This is the retail behavior. So eventually what I came out with is I compare closed P&L with all the costs that the users have been paying within the period of time. And what I realized is that all the retail traders, they have around 10% deviation from the costs to the P&L that they have generated. So they could have paid, let's say, 1,000 per one client with the spreads, commissions, and stuff, and he could make 1.1K in average. We are speaking about many clients for many.
The broker, right? On 900.
The client, let's say, for the broker is paying. All right. So basically, and if we see that there is a client that is consistently making, let's say, he made here, we have a situation. When the guy, let's say on Ethereum, here I have a breakdown by symbol. I just took one screenshot from, this is not relevant at all. But we see here that the Ethereum, let's say, or maybe Ethereum, yeah, it's fine. So Ethereum, let's say we have 5K paid with the spreads, and the clients took 22,000 out of the Ethereum. So like if we have this situation, it means that they are paying much less to you as a cost, and they are taking much more than they pay from the market. So this is indicating that either you have a problem with the instrument, either you have a problem with the client categorization, either you have any other problem, but it's definitely not a retail behavior. So
So you have an expected revenue you should be generating, your dollar per million, which would be pretty predictable based on your historic performance. And if you see a significant deviation from that expected value, you should be investigating either your trade conditions, specific client, a symbol setup, or
especially over time. And if you guys watch, like most probably any of you have these gold Asian flows. If you go and check how much they paid as the spreads, you will see that they pay you 5K. And how much they took 50K. This is the biggest indicator that something is not going well.
And most of those issues are solved with configuration. Like, it's not even like
and
you don't find
sense.
you don't find market abuse often, right? It's just usually misconfiguration or something in the trading terms. At least that's what I see mostly whenever a broker turns to me and says, "Oh, I'm struggling with this." You look at it and go like, "Well, this is actually, you know,
absolutely
you didn't charge enough." That's all it is.
It's just another approach. This one is kind of a generic, but it works over time. If you go like with MT5 brokerages, it's very easy to do this kind of report. With MT4, it's impossible. No, it's still possible.
Well, you can get a
you
data
can parse the
from,
logs.
You can get a data probably from someone like us.
Yeah, you can get from the bridge, definitely, if you are executing the B-book through the bridge. But how many are executing through the bridge, the B-book? Again,
all of our clients are very good.
Okay, your clients are lucky, but in general, if you guys have the possibility to always compare the trading cost versus the trading result, this will give you a lot of insights, and like you will discover a lot of new horizons there.
Let's wrap up.
Please.
Nice spreadsheet,
Thanks.
Is there a ratio? Is there a ratio that that will be like your watermark?
Benchmark?
Is there a benchmark ratio that you start looking at and, okay, I need to pay attention here from your experience?
Yeah, look, in general, this works. Elina is hinting me is $1 per million, which is reasonable. Here, when I'm doing the check, thank you. So here, when I'm doing my check, you see I sort by the delta ratio. So it's like I did it by myself, like this ratio, which is basically the ratio between the expected between the expected revenue and closed P&L, and we get the delta itself. So we compare the delta to the expected revenue, and we get this percentage.
The question is, where did you get the delta from?
No, sorry, the question, let me be more clear. Is there a specific
The benchmark.
delta ratio that above this you start getting worried and you start paying more attention?
I would say just you sort it by the delta ratio, and you see whatever is much above 130%,
okay,
110%.
So if you look at all of your trade, there is obviously a bell curve. So whatever is on the top side of the bell curve, if you just sort it, you will see, okay, these guys are my, these are my Naughty list. This is my naughty list.
Your average is always around the costs of the trading. So let's say they've paid you 10 million with the spreads and swaps. You should be targeting somewhere this range, plus minus 10%. As I said, on the long run though. On the daily basis, it doesn't make sense because it's a randomized result you will get.
But it's always a function of the fees you're charging, if that makes sense, be it commission or swap or spread or whatever.
That's why we have this term expected revenue. Expected revenue is effectively your fees that you are collecting from the traders. So and that's actually that's very funny when I hear from the brokers like, we don't care about the spreads. Clients are
What's it all about?
losing anyway.
We don't know. Yeah, we're fine.
Like, we don't care.
We just sit on exposure. We're good.
Keep it whatever. The rebate, give it like 50% revenue share, 50% spread rebate. And what we have left, at least in the best case scenario, we get zero. Yeah, like we break even. So yeah.
I think we can take questions. Really,
I will be happy to.
We've been.
I will be happy to. Roman, please.
Yes, could you please elaborate more on the first chart with the price?
The spread decay.
Yeah, because it's not so obvious actually what you call the spread decay and what you can see on this chart. At least for me, I don't know.
Okay, so
thank you.
So you see the fat red line, yeah. This is the client's trade, and obviously, as you charge the spread, and that's what makes your mathematical probability. The reason why it's not 50-50 is because the client is paying you a spread. So this is a negative mathematical probability of we are working with, right, as a brokerage company. So 0 is when the trade happens, and T minus is before the trade, and this is after the trade. And you're plotting it against your liquidity, and how quickly did the client work through that spread? So how quickly did he become profitable, right? Does that make sense?
No, in general, I understand the idea, but I don't understand the graph. How you can
so this is the price on one side. Yeah. So the alpha is the liquidity provider price.
Where is the spread and when exactly it's like eating off?
So you go through like one, so you can see the blue. See the blue alpha is how you were pricing, but you would need to go back to the previous slide. The blue is the price, correct? Yeah, that's the alpha price. Yeah, that's. Where is my decay number? So you're going. So the trade happened when it hit where the two lines crossed. Here it's not. It's a good.
Here is not it, and you see it didn't change. So you like basically the general idea, if you allow, Elina. Yes. So the general idea is to understand what is happening with the price right after the action of the trader. So right after or right before, because it may be closing. So here we see that if here at this time frame the price didn't move, it means that he is okay. It means that he didn't know what is going to happen next, right? So here, if you see that the market is going up there within this time frame, it means that he knew what is happening in the next 500 milliseconds.
See on top if it's bid or if it's ask and so on.
So in this specific case, everything is okay. But okay, maybe not okay because we see that in 5 seconds it started to grow. But
yeah, it depends on how much of decay you're looking at, right? So that's the previous one. So this is just plotting a specific trade. So if you want to look at a specific trade graph, you can do that. But if Brenda would scroll up and up again, so this is already per account. And you would see in the review required, like if it's true, it means that we are highlighting this one for you to have a look. And we say, okay, pay attention here, because based on the decay you've set up, because you can decide on the markout and the time frame that you want to be tracking and the liquidity that you want to be tracking it against, so the alpha, we say, oh, actually, based on your parameters, these are the ones you should be looking at.
Okay, I see the forms to put the weighted average price.
So these are the markouts. So these are like this. So minus means T minus, and then you do 25 milliseconds. Oh, sorry, 250, right? 500, and so on. So it depends. You can set up what kind of decay you want to look at.
So for example, if I put, let's say, half of the second decay there, in which form of this?
It's. I mean, I can show. Do you want to see a demo? Let's do a demo, because this is just a screenshot, but you can edit it. Okay, you can filter it.
Everything within this limit will be highlighted.
Yes.
Any other question, guys?
Miroslav.
How do you use negative trade decays? Only for closing trades or any other?
Negative, so T minus.
T
So how do you
minus.
use T minus? How do you use it, or how do you see it? No, when there
How
is
do
T
you use
minus, what is it for? What's T minus for?
For example, if you split the trades like to be every single trade to be like in 95 deals, you have opening and closing separated. Do you need negative trade decays in this case? Do you try somehow to understand if like the market reverse and to see? Yeah.
Look, okay, the second part was not very clear to me, but I will reply your initial question. So, how do I personally use the T minus decay? Is, as we said, instead of opening the trade, you may be closing the hedged positions that you used to have from, let's say, from yesterday. So in this case, majority of the brokerage systems will not catch you because it's not a fast trade. And still, brokers are catching the latency abusers with just the fast trades. Okay, open, close within 10, 15 seconds. And okay, they have alert. But in fact, we have a lot of different cases when you know that this specific brokerage has the latency tends to delay, let's say, for euro-dollar. Then you just open the two hedged positions in the morning. You know that there will be a news release, let's say NFP for 30. And instead of opening the trade in the direction of the market movement, you close the reversal trade. Right?
Okay, I understand. Yeah.
Okay.
For me, because I'm not as sophisticated, maybe someone will need it. Thank you. I'm not as sophisticated. I just look at what was happening to the price. You know, if you see some sort of a price spike all of a sudden, and then how the price continues performing. So that could be insider dealing, whatever.
Do you consider hedged trades as also a sort of closing? Remember, at Alpar, we did this. I mean, hedging is also an alternative
I don't know. What
to
do
trade closing. So
can you speak normally?
Yeah. So imagine a client entered the trade, and then instead of closing it, it hedged it. Exactly at the time
This
of.
is what exactly I was
Yeah.
speaking now.
As I understood, it was a scenario when the hedge was at the opening. You open a hedge and then you closed it at the time of opportunity, at the time of arbitrage. In other cases, when you open a trade, one trade, and then instead of closing, you hedge it at the time of arbitrage.
Okay, yes,
and
good
then,
point.
Like day after or 2 hours after, you close both the trades.
Good point, though. This is much more obvious, and this is covered by the T plus spread decay. So
Say it as T plus, yeah.
Yeah. This is basically it's opening, and instead of closing, you hedge, and then maybe you close it with close hedge, or just close it normally, whatever. But in general, this is covered by the T plus.
The standard decay.
Yeah, standard decay. It is, I believe, it's covered.
Yeah. That's the standard logic. That's the most standard
Yeah,
logic.
it's fine. Any other questions, guys?
No more.
Amazing.
You're free.
We're free to go.
Dobby is free.
Yeah.
Okay.
Thanks a lot, everybody.
Thank you for listening to our talking.
Thank you.
Enjoy your drinks and food. Hopefully, I'm starving.
Yeah. And by the way, guys, sorry, just one more important announcement. We just forgot the main
but I think
stuff.
we're gonna do it there.
We will do it there. We'll do it here as well.
Okay,
look,
go for it.
Today we have actually we are releasing iteration.
You are, not we are. You are. Yourfintech.
My company, my beautiful team is releasing a trading platform. It's a second iteration of the trading platform, and we try to do it as we like it to be. So I would appreciate if you guys take some time to participate in our trading contest, which will be done today. And the trading contest is quite simplistic. You will just scan the QR code, try to generate the best ROI within the day, within the team,
within the hour,
within the event, until 10 o'clock in the evening. And we have 3 nice prizes. We have AirPods Max, AirPods Pro, whatever AirPods as well. So you are allowed to do anything you like, to use the best practices out of the industry, like hedging,
Can I
whatever kind of arbitrage, please. No, so
you can trade gold, yeah.
So you can trade gold or follow the clients that are doing some stuff.
You can open up your clients, the toxic one, and follow them.
If you guys would like to see the platform itself, we have a dealing desk there on the patio,
side next to the bar,
open air. So please feel free. There is a guy who is very interested in that stuff. His name is Eugene, and please feel free to do it. We will appreciate your feedback, whatever it is, good or bad. Yeah, absolutely. It's ready for the market, and today we are doing the contest. Like is
on
mobile
his platform.
Or is mobile, is desktop, basically.
So if you'll find any bugs, you can address it on the spot.
Absolutely.
I'm joking.
And
there are no bugs.
Yevgen will get cut of his salary. Kidding, of course.
Victor, that one is for you to troubleshoot.
Yeah. So, guys, please feel free. I would really appreciate any feedback because we are doing a product that we would like to use by ourselves. So, thanks a lot again, and
thank you.
Let's have some
I'm
fun.
I'm gonna go win the AirPods, big ones that cover your whole head, whatever they're called.
All right.
Right.
Let's do it.
Thank you.
All right. Thanks, guys.